Hello, and welcome to the Silicon Alley Podcast. Super excited you could join me today. I'm William Glass, CEO and co-founder of Ostrich, and of course, short host of the Silicon Alley Podcast. Now, on the Silicon Alley Podcast, I talk to entrepreneurs and top performers to understand what it truly takes to grow and scale a business. You'll get actionable advice that you can apply in your own business and life. Now, on today's episode, I sit down with Axel Meierhoefer, the founder of Ideal Wealth Grower, a residential real estate investing system and consulting practice. Before I jump into what you can expect on today's episode, if you have not already, please make sure to follow and subscribe to the Silicon Alley Podcast wherever you're listening or watching so you get notified when episodes drop every Friday. And of course, if you hear something that you like, please be sure to share the podcast with others. It's the only way the platform grows. So today's guest, Axel Meierhoefer, is a retired Air Force officer who started his first company in 2005, focusing on consulting, employee skill development, and program management. As a business owner, Axel began thinking about applying profits towards retirement. Research clearly indicated that owning real assets would be the best way to achieve that goal and is also the path that the government supports above others. This led Axel to develop a residential real estate investment portfolio currently worth about $1.5 million. Now Axel teaches the many lessons he's learned to others through Ideal Wealth Grower. On today's episode, we discuss the difference between owning a business and owning a practice. There is an important distinction that Axel learned the hard way. You'll also learn how to vet turnkey real estate providers as an out-of-state real estate investor. And perhaps controversially, Axel shares how you can play within government rules and utilize them to your advantage as an investor. So without further ado, I hope you enjoyed today's real estate focused episode of the Silicon Alley Podcast featuring the Axel Meierhoefer.
You got no time to waste, but still you hesitate. Caught in a circle saying I'll never leave this
Axel, welcome to the Silicon Alley Podcast. Super excited to have you on today.
Yeah, hey, thanks for having me, William. I'm really glad that I could come on.
Yeah, absolutely. And excited to dive in. You've got an interesting background and have done some entrepreneurial things, also been in the Air Force and now are in real estate and kind of giving back. And so I'm excited to talk about your journey and sort of how you've built what you've built and your experiences along the way.
Yeah, absolutely. I'm looking forward to that.
So Axel, for folks that may not be familiar with you, could you give a quick little background, sort of elevator pitch on who you are and what it is that you do?
Yeah, so my name is Axel Meierhoefer and I'm originally from Germany. I was an officer in the Air Force and came to the US 25 years ago through an exchange program in the Air Force. And then after I finished the time in the Air Force, I got recruited as an executive into a software company. And after a few years of that, in 2005, I started my own business as a consulting company, and then more recently expanded it into the Ideal Wealth Grower. The consulting work is still going on, and what we do at Ideal Wealth Grower is mainly helping people through mentoring and coaching to understand and take advantage or be introduced to our existing relationships, because I'm still an investor, I'm still growing my portfolio, and so all the relationships that I formed with the turnkey providers, the lenders, the insurance providers, and so forth, basically the whole team that you need to do this in a successful and not very time-consuming way, is basically made available to anybody who decides to work with us. It shortens the time for anybody who doesn't want to study all this stuff that I went through the last 20 years. But it's also, a little bit of guidance along the way, because not everybody wants to do it exactly the way we do it.
Yeah, no, absolutely. And thanks, Axel, for that background. I'm curious. I definitely want to get into what you're doing with Ideal Wealth Grower, but I'm curious in terms of the Air Force. Can you talk about the experience and what you learned at your time in the Air Force, and then a little bit about that exchange program? Because I'm not super familiar with the military and those types of programs, so I'm interested to hear that specifically.
Right. Yeah. So I had really not just a great career, but also an unusual career in the sense. So I did my first experience with the United States was through pilot training, which happened in Texas. So then came back to Germany and actually started the normal route that an aviator would go through. And I was told there would be an opportunity. And maybe I should expand a little bit. When you are an aviator and officer, you're not just flying every day, but typically, and this is true for the US Air Force as well, you get kind of like an additional job, some kind of specialization that you do. And my specialization was electronic warfare. So how do you protect the plane from being shot down from the ground? And so while I was in my first few assignments, I was notified that the government was planning to build a new plane specializing on electronic warfare. And so I applied that I could be on the test team. And interestingly, all the black boxes that go into the plane come, or at the time at least, came from American companies. So when you're in this really early stage, when it's kind of like a car, right? If they're trying to do like autopilot, for those few people who are actually involved with this testing, that the only place you can get the information is right from the manufacturer. So my wife and I and my daughter came here a few times, like 3 or 4 times a year for like 3 to 5 weeks, for me to learn directly from the engineering teams, how do these things in the black boxes work? And so then go back to Germany and test it in the plane. And in that process, my wife said at some point, wouldn't it be nice if we could stay in the US, and especially in the nice weather areas, a little longer than just for a few weeks at a time? And I looked into it and found out that there's actually an exchange program between the German government and the US government, where I literally became in every aspect a US Air Force officer, and a friend of mine became a German Air Force officer. I took my job, I took his job. So I learned to fly F-111s and he learned to fly the planes that I was flying. And originally that was only supposed to be for 2 or 3 years. And then another project came right after, and I was already in the US, and they said, hey, would you just like to stay and do that? I did that for almost 5 more years. So now I was in the US almost 8 years, and I got to the point where I couldn't have continued flying. We call that the choice to fly a desk or get out. I didn't want to fly a desk, so I got out and then got recruited into this executive position at the software company. Now, to your question, what did I learn? 2 things, basically, that there is a certain discipline that is not just what you see in the movies, but there's a certain discipline that is related to what are the principles that really you as an individual or for your family or how you appear in life, that you give yourself and that you live by. Some are ethics-based, some are morals-based, some are like German, like being on time and stuff. So I found that to be really important, especially as I got further and further in my career, there was also more and more people that I was responsible for that reported to me. And I always felt it was important that they didn't report to me and did what we wanted to do just because of my rank, but because of the relationship. And that is very much based on those principles. And then the other thing is, you can imagine with the military, you get moved around from station to station. And in several cases, we actually bought houses, which was kind of like a little bit of an introduction into, okay, being a homeowner, and then you get moved away to another location 2 years later, but you oftentimes still have the home because it's not always the easiest or best time to sell exactly at that point, right? So those would be the 2 things, like how can you, I called it at the time the Hansel and Gretel strategy. You know, you're leaving a house as the form of a breadcrumb on your journey from station to station. And at the same time, really become clear on what are your principles. And I found that they last and continue to be around even beyond the military, beyond the work as a employee, basically, and into my entrepreneurship now.
Yeah, no, that's really interesting, Axel. And like, yeah, the relationship piece obviously is super important. And then getting exposure to real estate just by chance as you continue to move from place to place.
Yeah, exactly. Yeah.
So when you made the decision not to fly a desk, as you put it, you ended up in a technology company. Like, what was that experience like, transitioning from being in the public sector, the military, into a private organization? And what were some of the challenges that you faced?
For one, I made the decision not just because I didn't like or somehow didn't want to be in the military anymore, but really because I always felt that there would be more than basically a government organization. I mean, a military service pretty much runs like a government organization with all the benefits and detriments that come with that. And I was really curious to see, could I make it, so to speak, in the real world? Now, there was on the one hand excitement there because I had never been exposed to the money focus. Right? Like when you're in the military, budgets and money, even though I was, just below the general's level, but even the generals only can really manage a budget. It's not really for you to say, okay, here is the amount of money you have. Now I got out into the quote unquote real world. And that was one of the main drivers was what's the budget, how much money, how much sales, how much profit, and so forth and so forth. So that was one thing that was exciting and new to me. And I had to learn this really fast. The thing that I was disappointed about, and this is also why I only did this for a little bit more than 4 years and then started my own business, is there were a lot of things that I thought that the size of the organization, like an Air Force or a military service, would not allow me to do that. I would, especially in a smaller software company, be able to do, have more freedom, more decision power and stuff like that. And maybe I was just unlucky, but I ended up in a company where pretty much everything was either decided by the original founder and owner or by the investors into the company. So even though I was literally on the board, if you want to call it, with the owner in the room almost all the time. But when it came to, are we spending the money or not? Or are we going this strategy or that strategy? The buck always stopped with him. And that wasn't really what I expected to be the case. And part of my decision to start my own business, I think, was also, on the one hand, to be fascinated to say, how would that be if I were in that role? But I really also have to say, and when you look in my academic background, one of the cool things the government allows is, if you hadn't already done it, to get some money to get a degree. So I took it a little too far, I guess, and got a PhD in leadership. But part of that was also to say, there must be a better way. There must be a combination between the good things the military does, the good things a single leader does, but also some things that they don't do that I want to actually exemplify in my own business.
Yeah, that's really interesting, Axel, being able to, try to take the good things from both and apply those. So what was that like as you started your own business and tried to find that balance?
Well, one thing that is a really interesting thing, and I'm pretty sure that would be very interesting for your audience to contemplate, is that I had always thought business is business. And what I had to learn, and I'm kind of trying to get that question answered oftentimes when I talk to other entrepreneurs, is the question, do you really have a business or want to have a business, or do you have a practice? Because what I found out is when I first started, and I would even go as far as saying that is probably pretty much true still to this day, even though I have grown my team. Yeah. But the difference is that a practice basically is very dependent on either the founder, the inventor, or stuff like that. Whereas a business, somebody starts it with a good idea, but it's scalable and you can ultimately remove yourself, you can sell it and those kind of things. I oftentimes use the comparison to like a dentist practice, right? Yeah. So it all revolves around the dentist. And when the dentist isn't there, no teeth get treated. Right. And you can't just say, oh, somebody else come in and take over for that. No, it's not like that. It's a practice. Right. Yeah. Versus a business is different. So for me, even though I thought I would be founding a business, I ended up actually founding a practice that has support staff, all kinds of people doing all kinds of things. But it still revolves around me. And the main thing, I guess, what is an indicator, if you have the one or the other, is what are your clients actually saying from the company perspective, what they want. And what I found is I always thought they wanted coaching, they wanted program management, they wanted workshops, they wanted all kinds of things on the service side that we were offering and have on our website. But when I really said, okay, well, I have a great person for you, then no, we want you. And so I said, well, but William is just as good, maybe even better. No, we came here, we sticked you out, we got referred for you. Not for William or Joe or Frank or Susie or somebody else. So that, I think, is a good indication. Do you have a practice or do you have a business? What I found is that there is a little bit of bridge building, because I'm really priding myself to have a very democratic approach in the business. As far as all kinds of decisions and stuff that need to be made, I can change the client. If the client says, hey, we want to work with you, we want you to be our advisor, consultant, coach, mentor, whatever. And that is also a little bit I saw in your questionnaire, how did this transition into Ideal Wealth Grower actually happen? That was basically because I told people about some of my real estate activities for my business and my family. And they said, you should tell other people about it. right? And so then I said, okay, well, I can do that, but I can't do it all by myself, and we need a team for that. Yeah.
Gotcha. Yeah, that's really interesting. So the decision to start talking about real estate, that was driven from just having conversations with people, building those relationships, as you talked about, going back to the military background, wanting people to sort of respect you and want to work with you, not based on rank, but based on your relationships, and taking that into the practice. So that's where the real estate focus came from, and where people started to latch on to your story or advice that they were seeking?
Yeah, it's part of that. It's a strong part, a strong component of that. The other thing is, in general, I find that people have multiple ways that they see as obstacles for not doing something. One is that I find constantly and try really hard to overcome and educate people to not continue to believe that it takes huge amounts of money to get into real estate investing. But another one is that almost everyone in real estate has somehow that label too. Every one of those areas where you want to do something that is not in your normal comfort zone, it's probably complicated. And I would say for real estate investing, almost every type that you do, it is pretty complicated, but it's also in a way logical, which is good for somebody like me who comes from test flying in Germany and stuff like that, right? You can logically explore it. It all connects to each other. And then the relationship part that you were referring to is just a little bit of a matter of personality. Okay. People oftentimes say, oh, there are hundreds or thousands of properties out there. How do you decide to find one? And I say, I don't. And then they look at me and say, what the hell? How can you be a real estate investor and don't find properties? And the answer really is, I have literally 5 turnkey providers who I've developed relationships with, who have the properties that I own in my portfolio and who I offer, not force, but offer people to use with my help. Because when I call them and say, hey, I have William and he's interested to explore the properties you have available right now, it's different because I already own a bunch of properties with them than even if you were to find them yourself. But the point about it is, I have the relationship with these 5 providers to the extent that they know what my criteria are. Yeah. So I don't need to go on Zillow, Redfin, or all this other stuff. They send me emails and say, hey, since we know who you are and what you want, and you already have 4 or 5 or 6 in with us, we have just this next one coming up that we're working on that seems like a perfect fit for you. Yeah. Would you like to take a look at it? So that's the explanation, but people are always like, what, you don't look for deals, but you're constantly adding to your, yeah, right? There's a method to the madness in a sense, but it comes back to you build the relationships. And I have found you can't have too many, right? Some people say that you can never have too many relationships. Well, in certain things, when the subject matter is somewhat complex, it's more a matter of the quality than the quantity. Okay. So for me, having 5, and I can't imagine that I would ever need so many more properties that those 5 turnkey providers would ever be not enough.
Yeah. No, that's really interesting, Axel. And there's a couple of things that I'd love to dig in on. I guess the first is, how did you settle on turnkey? You alluded to the fact that in the military, you had to move around frequently and would end up with properties if you bought a home somewhere. I guess, what was your first exposure to becoming an investor? And then how did you settle on turnkey and turnkey providers?
Well, I had, like I said, from this moving around, and then also even after the military, moving to where I was recruited into the software company, I had purchased these properties, and I've always been interested in learning more and more about it. I mean, it's a fascination. It's also a business, but there is also a certain passion about it. And then this logical component of, what can I learn? How do the numbers work? And one of the things that I discovered is by listening to podcasts, like, for example, yours and others, and reading books and so forth, is that there is a really, really important term that I believe is not emphasized enough, and that is performance. Okay. A lot of people look at appreciation way more than at performance. And so when I learned that, I looked at all my properties and said, okay, how do they perform? And to be honest, and I don't want to use a cuss word or something like that, but
you're fine.
Pretty much the performance sucked. right to say it.
So what is performance? Can you expand on when you say performance, what do you mean? Because obviously, yeah, there's the paper, oh, it's now my property is worth $2 million and I paid $100,000 for it because I bought it in LA. But can you talk about that and what do you mean by performance exactly?
Yeah, performance is basically related to the purpose of why you're doing the whole thing in the first place. And keep in mind, we're talking about investment properties, not your own place that you live in. So an investment property's performance, most of the time, at least for the types of investments that we do, which is residential real estate, meaning like single family home, duplex, triplex, fourplex, those 4 options. So for that, you want to look at how much did I pay, how much rent do I get, and how much is left over for me to spend freely after everything is paid for, or it's also called positive cash flow, right? And ultimately, there is a whole journey. This is why I say what we're really doing is coaching and mentoring and guiding people is, I would say, William, if you were, for example, a client, let's figure out what is the number some point in the future where you would reach economic independence, which means enough money coming in every month without you having to do any work of any kind, or I call that exchanging time for money, and still have everything covered. So you might say, well, where you live, that's $5,000 or $6,000. Other people may say $2,000 or $3,000 in San Diego because it's really expensive. It's more like $8,000, which is also a reason why you need turnkeys in other places of the country, because here it wouldn't be possible, right?
Yeah.
So you set that number and you reach that number at some point in the future. And so how do you actually reach that number? By individual properties in your portfolio. You have your first house that gives you $200-$300 a month after everything is paid. The second one, the same. And let's say, like in my case, I have 10 and they are different levels. So they're anywhere between $350 and $500. So there's like $4,000 if nothing else comes in. So 50% of my economic independence number is already there. And I keep working on adding more to it. Now, if I were to say tomorrow, well, I like the climate, but it's too expensive, I move to Florida, I could stop right away and probably had money left over.
Yeah.
So the economic independence is not automatically related just to the number, but it's also related to the location that you live in. But so you're setting this number, and now you go, when you say performance, if I look at a property here in San Diego versus a property that I get from a turnkey provider, the average houses that are anything that you would even ever consider are around about $500,000. Wow. You can spend way more, but that's about, where you get in the door, 3-bedroom, 2 baths, 1-car garage, stuff like that. Then on the other hand, I can buy 5 $100,000 houses somewhere in the Midwest, let's say in the Chicago area, right? Same amount of money. The houses here, I won't be able to get $5,000 rent or 1% of my purchase price. Yeah. But I can, on each one of those $100,000 houses in Chicago, get $1,000 rent. Right? So the performance is 1%, if you want to make that calculation, in the west of Chicago, where I own a bunch of properties. Whereas the San Diego area, I get maybe 0.4, 0.5%, and few years in the past, maybe 0.6%, but nowhere near. Right? Now, the other thing is what plays a role in the performance as well as how risky is it? Mm-hmm. Right? So if I get one property here for $500,000, let's just say I find somebody who somehow wants to desperately pay me $5,000 rent, right? So I would say, yeah, that's 1%. But if that one gem of a tenant ever leaves, I'm probably screwed. If I look at my 5 $100,000 houses in the Midwest that a turnkey provider is actually managing for me, even if one leaves, I still have the other 4. Yeah. Right. So it's the performance in numbers, but it's also the performance in numbers in the sense of numbers of properties, not just numbers in rent and so forth and so forth. So that hopefully explains a little bit. It all goes back to the 1% rule that I always say that is a really good starting point. And yes, sometimes it's 0.9, other times it's 1.2 or something like that. But you should look. And then you ask yourself in your area, is that possible? Is that realistic or not? And that for me meant most places I've lived after my military life were always more expensive than the 1% rule dictates. And so I had to find somebody who managed this stuff for me. And that's how we got to the turnkey providers.
Yeah. And can you just define 1% rule? I know you've kind of touched on and given a couple examples, but just clearly hit what you're referring to when you say 1%. If I don't know anything about real estate investing, what's the 1%?
Yeah, if you weren't using any help or something, you just go on Zillow and say, okay, I look for a property somewhere. You want to find what's the price for the property, and then you go on a tool called Rentometer, which is another app, and you put in the address for the property, and it will tell you what is the typical rent level around this property. So let's say that property cost $100,000 on Zillow. Then you want to see that the rent is $1,000 or more on average in that area, because that's 1% of your purchase price.
Per month, to clarify. 1%. Yeah.
Per month. Yeah. Right. Exactly. So that's kind of like your anchor number to look for. Now, like I said, it can fluctuate a little bit, but in the more expensive areas or in the bigger cities and stuff, you're lucky if you get 0.5%.
Yeah.
Right. And so the performance thing is actually, when you go back to your original question, you said, okay, what did you learn through all of this? Is that my Hansel and Gretel breadcrumb properties were either in areas where the rent level was way worse. So I basically paid too much for the property and could never recover the rent to a level that it would be 1%, or the property was in an area where you would just never be able to ask that much rent.
Yeah.
Right. So I had one in Santa Barbara that was a beautiful property, $800,000 or stuff like that. But who pays you $8,000 rent? If they can pay that, they might as well buy a property. Right.
Yeah.
That's the other thing that you also need to keep in mind. There needs to be a reason for somebody to rent your place. And the reason is typically that they're either not yet at the point where they could purchase themselves, if that's an intention, or they deliberately want to be a tenant. But I don't know many people who want to be a tenant for $8,000 a month. So that's kind of like a little bit in a little more detail how these things are all connecting, even if you just look at that level of number. And then it becomes a matter of, okay, where do I go? Which turnkey providers do I work with? What are the criteria? And how do you end up, like in my case, then with 5 instead of the hundreds or thousands that are out there? You know?
Yeah. No, that makes sense, Axel. And so there's so many different asset classes out there, right? When you think about real estate, you could get into large apartment complexes, you could get into commercial properties, you could get into flipping and wholesaling and all these different things. Why residential real estate specifically that are for family and under?
Well, there's a couple of reasons. The first reason for the 4 family and under has to do with the rules. There's something called FHA financing, or government secured financing, which basically means the way you borrow money to purchase any of those properties is the same like you would borrow money for your own house that you live in. As soon as you get to and the calculation is by doors. Out of some reason, they came up with, okay, how many doors do you have? And so you fall under this FHA or government insured financing up to 4 doors. So 1, 2, 3, or 4. Anything beyond that is considered commercial real estate. Now, that can be commercial residential, it can be commercial like a strip mall, it can be commercial like an office building. There's different kinds, apartment complex and so forth. But less than 5 is considered residential and government insured. And that makes a huge difference. But there's other differences as well. So when you look at how do you buy your house or how do you buy one of those houses, why, and one of the reasons I went into is a little bit the Buffett rule. And my interpretation of that is I want to be involved in stuff that I either already have experience in or I understand it pretty easy. Right? Okay. I live in a house. I've pretty much my whole life lived in a house. Been very lucky that I only once had to live in a military dormitory. Other than that, my whole life I've lived in houses. So I know how it is to live in a house. I know what things I look for when I live in a house, whether I own it or I would be a tenant. So that experience is there. I understand how that goes. Then the other aspect that is really important in that context is control, right? So when I live in a house or I want to buy a new house in a new location, the first thing that happens is somebody says it costs, let's say, $120,000. I say, okay, that's what you say. I sent you an appraiser, or the bank sends you an appraiser, and they say, yeah, that's true. 120, 125 is about fair. I had a situation where I wanted to buy a fourplex west of Chicago that was offered to me at $230,000, which for anybody on the coast would say, what, a fourplex for that money? Right. And it was freshly renovated on top of it.
Wow.
And it was appraising for 165. And what that means is I would have had to literally put $50,000 cash on the table if I still wanted it. Right. So I said, okay, something must be wrong, because the appraiser said, okay, this is just completely the wrong type of property in this neighborhood of the city. Not because the building itself would never be worth it, but, it just didn't fit. And appraisals look at how does it fit into the neighborhood. Yeah. So it didn't appraise. Now, if you look at a commercial property, let's say your apartment complex with 50 units, none of that applies. Now, I know about it because I wanted to be informed before I decide which area actually am I going to stay in, or may I actually expand into larger things or commercial or whatever. Apartment complex valuation, just as an example, and this is true pretty much for everything else in commercial real estate, is purely based on how much rental income do you make. So if you say you have 20 units and you have $1,000 per unit, right? So that would be 20,000 a month times 12 is 240,000 a year. And then you put a multiplier on it, and you might say, okay, we do this for 5 years. So 200,000. So this whole thing is somewhere between $1 million and $1.2 million. And then when people say, well, how is this attractive? They say, well, I'm going to go in and spend $10,000 on each one of these units and then rent them for $1,500 a month. And then my valuation has gone up by 30%. Now, that might be a little fast for some people in the math, but believe me, it would be going up by about 30%, right? So you buy it for 1.2 million and then you sell it for 1.6 million. And you see in the newspaper, a guy made $500,000 in 9 months.
Yeah. It's
all good when it works, right? Except for the fact that then you suddenly go from 95% occupancy to 85% or 75% because there's nobody in the neighborhood that can afford $1,500. Right? Because asking for it and getting it is two different things. None of all of that valuation, the dependence on how high do I have to crank the number to actually increase the value, none of that applies to your normal average house. And I just decided, okay, for me, what I really want to do, yes, I want to be an investor. Yes, I want to accomplish the economic independence. Yes, I want to get to a certain number in passive income. But more importantly, I want to provide a service for families who would like to live in a nice house at an affordable price. That's my main motivation. So they say, I'm proud to live in this place. It's nice, it's clean, everything is working. I see it as an obligation to pay my rent because I get good value.
Yeah.
The fact that the place appreciates in value and that I have positive cash, it's all side effects. Yeah. The main thing, the main motivation for me, and that's what I'm kind of trying to get my clients into, is mindset should be, I want to provide a service to humanity. And if everybody, the turnkey provider, the tenant, and I all benefit from it, then it's good. It's a win-win-win, and that's what we want.
Yeah. Yeah, no, it makes a lot of sense, Axel. And I like the fact that you're coming at it from this lens of wanting to provide a service versus just tracking back to that economic independence number that you talked about earlier. And it's not just about the numbers, because I think that that's a really important thing, especially if you're buying things out of state. Can you talk about some of the criteria that you use with your turnkey providers and some things that are a little different that help you avoid the fact that maybe you're not familiar with certain areas of Chicago in the Midwest and you don't end up buying a renovated house, but you're in an area that is, you're not going to be able to keep a tenant for very long. There's high turnover and you end up in a really bad neighborhood, so to speak. Like, can you talk about your system in order to avoid some of those things and make sure that you're buying good quality properties?
Absolutely. Yeah. So the umbrella term that I have found is pretty fitting in this context is dependence. What I look for as an investor is finding situations that have basically natural dependencies. So when you say, okay, how do you find the right area? Well, the turnkey provider, if you think and put yourself in their shoes, they make the decision, we want to find the ugly duckling in the neighborhood and renovate it to make it into a pretty white swan. because when it's that, then we, number one, can sell it for a good price. It appraises for a good price. And guess what? When we then actually manage it, because we are a turnkey provider, not just a flipper or something like that, or wholesaler, we are going to manage that property that we just finished renovating and selling to this investor. So we better make sure that it's something that is not too hard to rent, that is a nice neighborhood that has all these criteria. And when you only look at it at one deal, that may or may not be that hard. When you look at a whole area, like in like, for example, the Quad Cities area west of Chicago, and one of my providers has 900 properties under management, right? So they have a clear dependency to find what the right neighborhoods are, renovate to the right level, know what the kind of tenants are that live in the area, what kind of properties and quality of renovation are they looking for. All these dependencies are to the benefit of me, but they're also to the benefit of the turnkey provider. And the criteria, to get back to that point, is I only work with turnkey providers who find the property that is in need of renovation, do the renovation, then sell it to me, and also under the same umbrella, do the property management. And there are a few additional things. They need to be willing to accept that I want to have a signed lease agreement at closing, which means from day one, there's rent coming in and positive cash flow. The other thing is I have, with mine at least, negotiated that we create what I call the binder, which is actually, for your listeners, they will all kind of have experience in that. If you ever buy anything, light fixture, faucet, whatever it may be that goes into a house, I always say if it's connected to water, electricity, or gas, and you go to the register, they say, William, would you like to have the extended warranty? And you say, how much is it? And they say $18, $20, or whatever, something like that. So what we do for the properties, and this goes back to the relationship, is I ask my turnkey providers for anything that goes into the property to get the extended warranty. That adds up to somewhere between $500 and $1,500 additional cost for the renovation. But keep in mind, 80% of that is paid by the bank, right? Because it goes into the sales price. So now I have a house where pretty much everything that could break has a 3, 4, 5 year or longer warranty on it, and it's all in the binder. That also means, even though I'm still preaching for myself, I'm doing it and my clients do it, to put a little bit of money for maintenance and capex and reserves and so forth aside in an account just to be on the safe side. But in reality, after I purchase it, the first 3 or 4 years, I shouldn't have to pay anything, even though it's not new construction, because it all has this extended warranty on it, right? And so that way, your cash flow is really pretty much assured. And there are, when you look at all the turnkey providers out there in the country, you will find very, very few willing to really do all three: the finding and renovating, the selling, and the management under one roof. And those are the dependencies, right? If you make a shitty renovation, then guess what? Anytime the tenant says this breaks and this breaks and this breaks and that breaks, you always go out there and you do it on your dime.
Yeah.
So
Exactly. And that's the horror story, or the bad side of turnkey providers that don't manage property. So they just sign whoever has a pulse in as a tenant, or like you said, they do a terrible job renovating the property because they're just trying to do it as cheaply and quickly as possible.
Well, especially, I mean, you find a lot where they find the property, somehow renovate it either themselves or with a contractor, and sell it to you. And as soon as you sign on the closing table, then they turn it over to some local property management. And what you really, and this is the negative dependency, is you as the investor, now the tenant says, okay, the water line to the sewer system broke. And you say, well, that is probably something that should have been taken care of during the renovation. So you go to the people that you bought it from, and they said, no, it was all good when we did it. Then you go to your property management people and say, well, you should have inspected it, so, and warranty and blah, blah. And in the end, you're always in between these chairs, and you're constantly fighting with people, besides the fact that it takes you forever to get this all settled. That's the beauty that I have. People often ask me, how much time does it really cost you? I'd say on average, maybe an hour and a half a week for my whole portfolio. So
yeah,
I think that is pretty much the definition of passive.
yeah. If you can get, as close to passive as you can get, because I don't think there's anything that's truly passive in this world.
Yeah, well, I mean, if you totally don't want to look at it, then you don't do any management with your money, right? I want to know what happens with the money. That's the majority of the time I'm spending on it. It's not dealing about any kind of repairs and stuff. That's all taken care of. The thing is, I want to have some review every month on every property. Is how we doing? How's the tenant doing?
Yeah.
When do we turn over? Do they extend? And like this year, for example, because of the pandemic, I told all my turnkeys that we're not going to increase rent, and we notify everybody unless their term expires before Christmas, that on Christmas they're going to get told no rent increase for next year.
Gotcha. Nice. That's awesome. Yeah. I mean, that's obviously a nice gesture, but also in the midst of the pandemic, but also for you, right? You don't want a vacancy right now, right? That's something that is not a good thing, especially with just what's going on in the climate. And if we have more closings, and especially if you are targeting some of these areas where you are able to provide affordable housing, a lot of the folks that are able to be in those types of situations are going to be hit hardest.
Yeah, absolutely. Although I have to say, I've become over the years quite a fan of Section 8 because Section 8 doesn't absolve the property managers to do a thorough evaluation on character of the tenant and stuff like that. But it's just kind of nice. And I can say this without bragging. We have 98% rent collection this year, right? So it hasn't really changed, pandemic or not. But it's nice to know that for certain tenants, the government pays part or all of the rent that was agreed to. But this aspect of the not increasing the rent is twofold. One is to acknowledge and honor the fact that the tenants were able to pay their rent the whole year. But it's also one other aspect, and this is one thing that is important to me, and you decide if you want to dive into this a little more or not, but it's really utilizing all the rules, not just some of the rules. Right. And in that context, especially in this case, there were a bunch of rules in the context of the pandemic that were put out. And this is another thing why it's kind of beautiful, in a sense, to be in this residential real estate space, because those rules were only put out for people who have residential real estate. Right. So just in a very short nutshell, the government said with the CARES Act that anybody who has a mortgage can put it on forbearance. And then the FHA folks, who have 90% of all the money lending in residential real estate, said for all the mortgage servicers, when that forbearance period is over, that year that you basically didn't pay gets added to your original term of your mortgage. So if you had a 30-year mortgage, it now becomes a 31-year mortgage. And so that's part of the rules. They made a law for that. I applied for that, and I got approved for that.
Gotcha.
Right. So in reality,
so your mortgages are in forbearance right now. So you're not paying on those mortgages, correct?
Right. Well, I will be. I paid all the escrow monies. Right?
Okay.
Because that still goes on. You still have to pay property tax and insurance and all of that. So I covered all of that. But the mortgage itself, and some people say, well, how can you do this? Did you really get hit that hard by COVID? And I always answer with the question, if the government says you can deduct anything from your taxes, are you ever asking yourself, did I really get hit that hard to take advantage of this rule, or is this rule for everybody? Right? So people debate this, but for me, I play totally within the rules. I don't even try to get anywhere close to the boundaries. But whatever is in the rules is applicable. If it applies to me, I do it, right? And so in a sense, we were able to create a reserve much faster than we ever thought for the newer properties we recently bought, because we saved this. And one thing, by the way, when people say, well, don't you take advantage? I'm just saying and I don't want to get into politics, but I'm not so sure that people always really understand what some of these rules really mean. Okay. Because going from a 30-year mortgage to a 31-year mortgage means basically this year, and I understand that a lot of people are hard hit, so I think it's a reasonable rule. Although if I were the politician, I would have said except for investment properties, but okay, they didn't, so they didn't. But the other thing is, it's not that the money is not going to be paid. What the people that allowed this rule to be the rule did not understand, in my view, is that the value of the dollar we pay today versus the value that we pay in 360 months from now is totally different ballgame. Ask yourself what things cost 30 years ago. that is a fair comparison, right? 30 years ago, you could buy a car for $6,000. Now it's $40,000. So if you accelerate that 30 years in advance from here and you say, okay, then I'm going to pay for this year 2020, the value of that dollar has changed massively. That's the main reason. It's a literally financial mathematics point. It's not taking advantage of a rule. If somebody says you can use today's dollars or 30 years in the future from now dollars, what would you do?
Yeah. No, it makes sense. Yeah, you use the cheaper money, so to speak, right?
Totally, everybody would. And so I'm saying, well, since I have this advantage and a tenant doesn't have that, so I don't want them to have to pay more, when I already had this opportunity that they didn't have, right? I honor the fact that they paid their rent, and we also give them some gifts for Christmas and stuff. But those are things. And where are we again? Like I said earlier, it's all a matter of dependency. In this case, these rules and how they interact with each other and depend on each other can allow me as a landlord to say, hey, I want to do something good for you because I was able to take advantage of some of the rules that the government made for me.
No, it's interesting. And it makes sense when you put it that way, because my original thought was, well, what about the debt? Wouldn't you rather, I don't know what your philosophy is, because it obviously depends on who you go to. There's some real estate investors that want to, put every extra dime that they have outside of their reserves to pay down the mortgage so that they have them own them free and clear. Whereas it sounds like your philosophy is more taking advantage of the time value of money, so to speak, and focusing on more of the cash flow numbers and being able to acquire more properties versus having less properties but paid off, so to speak.
Yeah, exactly. Well, ultimately, when you keep in mind, and this is always an important point for me, is keep the purpose and the goal in mind. The goal is the economic independence number. And then you can ask yourself, how do I get there the fastest? And I would always say fastest and safest. Right. Okay. So the safest is to stay within the government insured FHA rules, because you're also protected with your money if your lender or anybody screws up or anything like that. So then I say, okay, well, so how do I get, let's say your and my number would happen to be $6,000 or $8,000 or whatever. So it's just a matter of look at the properties, how much positive cash flow are they going to make, and how does my money perform? So we talked about property performance earlier, but we can also look at how does my money perform. And I have not found anybody who can beat me putting 1/5 in and somebody else giving me the other 4/5, and then the tenant paying for both of it. That's a deal that is pretty unique in the world, right? But the aspect, 80% of the money comes from the bank, means my money, the limited amount of money that I'm putting in, can maximum perform. Right. And in a case like what we just discussed about the rules that the government came out with in context of COVID, allows for me to get more properties in the future much faster than I anticipated, because I can make that money work basically, and money working with money ultimately gets us to that number.
Yeah. No, that makes sense, Axel. And for folks that do have real estate and maybe haven't taken advantage of this, is this something that expires at the end of December, or is this something that folks can still take advantage of if they choose to?
Well, I'm not a CPA or like a expert on this. I would say go to your bank and ask, because forbearance is a matter. The rules are published because they are part of the CARES Act. But I can't say if, you can still ask for it. Right now, the time window was originally set to expire on the 1st of April. Now, again, politics is a tricky thing, and I don't know what's actually really going to happen with this whole election stuff and so forth. But a lot of people in the industry are currently speculating that this forbearance time window will probably be expanded. Yeah. And if that's the case, let's say they expand it by another 6 months until like 1st of September next year or so forth, then I would also expect that you can still apply for it. But I can only advise people, check it out, go to the bank or go ask your mortgage provider. The important thing, if you say, okay, how do I do it, is that you really need to phrase it correctly. You want to call them up and say, I have been impacted by COVID. I know there is a chance, or there is a rule that I can ask for forbearance. How long can I wait to invoke that rule for me, and how long will it last? And don't say anything else, just say that. Right? That's the one sentence or two sentences you want to say. They will probably ask you all kinds of questions, and has your income changed and this changed and that? None of it is relevant. all you say is, I have been impacted by COVID.
Yeah.
And I think we can all honestly say we have been impacted by COVID, because there is no definition of how that impact looks like. I mean, I can't go anywhere right now, literally. I mean, I live in a beautiful place, but everything is closed and locked down and curfewed and what have you, right? So it's not only financial impact, there's all kinds of impact. But the rule says you have to have been impacted by COVID. So when you ask, you better say exactly that.
I've been impacted by COVID. Yeah.
You know, it's the same thing like when you go other places and they want to hear a certain phrase, then the door opens or it doesn't open. So you better tell them the phrase they want to hear.
Yeah. No, awesome. Yeah. It's very interesting, Axel. And thanks for sharing that, why you've chosen to do that and take advantage of that. Cause that's something that I haven't heard as many people talking about. Axel, in terms of success, and when you define success and what the future looks like, what does that look like for you? What does success look like to you, Axel?
Well, for one is reaching that economic independence point, but it's also in the process, basically using the principles that I live by. And one of that is, for decades, I've always said the slogan, if somebody says you have to put it in one sentence or one slogan, has always been helping others help themselves become successful. And for me, that is really the greatest pleasure to say, hey, William, if you say you want to get into residential real estate because you discovered what your economic independence number is, then I want to help you for you to find a way to make that happen. And the more you like me to help you with that, fine. But you can also at some point say, now I feel I have done it enough, 3-4 times. I know enough about it. Now I can go on my own path. So you are now enabled to help yourself to continue to be successful.
Yeah. No, I like that. And I like how you've done it succinctly in terms of describing that. Where did that desire come from? Like, to help people achieve their economic independence number? Like, why does that resonate with you so much?
Well, for one, it's two things. The one is this freedom of decision making, right? I have, in my military career, only had the freedom when I was in charge of my little fiefdom, so to speak, and everything else I was contained. And I would go further and say, in most walks of life or areas of life, we have to fight to have the freedom to make the decision. Yeah. So on the financial side, I have found a way where I can actually literally help people to reach that point, to have that freedom, right? To say, what do I do with my time? And the other thing is, and this is maybe a matter of age, over time, I have actually realized that the one thing that is by far the most valuable thing you have is time. Even though when we are younger, we're not thinking about it that much, right? And so to really have the freedom to say, what do I want to do with my time? What are my passions, regardless of whether they pay anything or not, right? Yeah. If I want to be a painter, or if I want to become an archaeologist or stuff like that, who cares? As long as my costs are covered, I can do whatever I want to. That's the kind of freedom. And I'm not quite there yet, but I can already start feeling it, because when the pressure of having to make every penny starts going away as your passive income increases, you feel completely different. And I'm absolutely sure when I reach that point, it will be even more elating and fantastic to be in that position, to be able to say, I'm covered. Besides, there is also a service, and this goes basically maybe a little bit back to my military time. When you do this with real estate, or especially residential real estate, there is also the component that you do this in the long term. So I'm always saying, even though my daughter loves her work and her life and stuff like that, but if she ever gets kids, or if she ever comes to the point to say, I don't like my job anymore and I'm no longer around, she can just keep going. She will have that and more passive income from all the properties that we accumulated in the portfolio. And that's something that some people forget, right? You're also building a legacy and making sure that the members of your family in the future have this basis. In my family, nobody had that. I'm at least not aware. I'm the first one who has actually been on this journey. Yeah. But that makes me also proud a little bit to say, I want to create this so that future generations have it better than me.
Yeah. No, I love that. Yeah. I think tying it back, that legacy is really, really important in getting into that. So thanks for sharing. Axel, I'm curious, what would you say is the best investment that you've made?
Well, the best investment is probably a property that we lived in, one of the breadcrumbs in New Mexico.
Okay.
And the reason it was the best investment, we bought it at the low point from in the financial crisis times, 2009, I think, or something like that, or 10. And then we lived in it for a while and then came here to the San Diego area and we kept it as an investment property. Not the highest performer, by the way. But what happened is the city, still to my amazement, made the decision to connect that little neighborhood to the main business route around the city. And all the people who could save themselves 15 or 20 minutes of drive to work were suddenly super interested to buy properties. And so from moving within like literally in a year, it gained $100,000. And you might say in certain areas that's not a lot, but in the backwards areas of New Mexico, gaining $100,000 of value. So even though I'm always preaching you hold on to your assets, sometimes if somebody said, can I dump this bunch of money in front of you? And then I couldn't say no. And so I accepted it and turned it into 2 other properties.
Yeah. No, that's awesome. Yeah. It's not repeatable though, it sounds like.
No. I mean, you don't find cities that build the perfect road in the perfect spot all the time.
Yeah. Axel, on the flip side, what would you say is the dumbest money mistake that you've made?
Well, conceptually, the dumbest was to listen to people who say stock markets always go up. I did that in the time between about 1998 to 2001 or 2002. And I had made a really nice profit, even though I would not do it again. But I mean, I invested in really fast growing companies and could not imagine, because I drank the Kool-Aid, that I could lose $75,000 basically in a week. Because I was one of these people who didn't believe when the crash came that it was a real permanent crash, and didn't sell anything until it was basically done deal. It was stupid. I still made maybe a few $100 or something, but all these years of and we had like a club and we were talking about all kinds of cool stuff of what next and so forth. And poof, it was gone, right? And but the thing is not the fact that happened. It's the fact that the mistake was, do your research, know what you're doing, and don't just drink the Kool-Aid of what other people say will or will not happen, right?
Yeah. No, I like that. And it's interesting that you draw back to that time, because I think I see some potential parallels with what's going on now. If you look at the stock market relative to what the economy is actually doing, and people on Robinhood just going crazy, and folks that invested in Tesla or invested in some of these companies that filed bankruptcy like Hertz, and you see the stock shoot up. Whereas logically, the company's worth zero. You're the last one in line to go collect when it comes down to the debt. So,
so I mean, all these things that have to do with money, and I know that is a focus area for you, is I always say, and this comes from my military background, but it's also true as a lesson in life, is you want to give yourself goals. Right. And I always say the goal should not be greedy. So if you, for example, get in Tesla, and Tesla in 12 months increases by 100%, it's probably double your goal, and it was faster than you ever thought, then just collect at least anything that is above your investment if you want to do stock investing. But I think there are too many people, and it reminds me really vividly to the .com period. And I'm sure a lot of people that do it now don't even remember what that was. But where it's basically almost like an infectious disease, which I'm careful to use these days. But, that you're getting so infatuated and not realizing like the S&P 500 is basically 6 stocks, maybe 7. The whole rest, the other 490 are pretty much not doing anything. And the one thing that I'm saying, when you look at it from an economic perspective, where real estate is part of it too, is to say, okay, when are we actually recognizing the real fundamentals? And right now we can't, because nobody really knows where they're going to go. But when you get into sometime like Q2 next year, and you're going to say, okay, there's 3 more years for airlines to ever even get close to what they used to do in 2019, then the valuations just make no sense anymore. Yeah. That's why I'm also saying, you go into these areas like San Francisco, and then you say, okay, well, are the prices for that real estate going to continue to rise? And I say, well, we can't really totally say yet. How many of these remote jobs, work from home, are going to continue to be work from home, and how many are going to come back? But I think what you can pretty safely estimate already is not 100% are going to come back. Yeah. So this massively overpriced real estate for business, as well as real estate for people living and trying to live close to those businesses, is probably not going to continue. It's ultimately supply and demand everywhere. And so you have to make an informed decision. And the one thing brings me all the way back to residential real estate. There is Maslow's law or pyramid that says one of the fundamental first levels of humans is find shelter. That's why I'm saying, if I have to look at our stock price is going to go up, is San Francisco still a good area, blah, blah, blah. If I can provide fundamental shelter at a good quality for a nice family that has a reasonable job and a reasonable rent, then I'm pretty much in a safe place. Yeah. And when we turn it into the win-win-win that we talked about earlier, then it's fine. And all the other stuff might be every once in a while more performing, right? And everybody who bought Tesla 2 years ago is showing me the finger. I get it. Let's just see how it is when you actually say, okay, are your kids still benefiting from your Tesla purchase now or not? Yeah. Which mine will, because the passive income will come, because the fundamental need of shelter will never go away.
Yeah. You're playing on a different time horizon,
Time horizon, but also, slow and steady. You may have heard that in some kids' books or stuff like that. Slow and steady has always won the race. Yeah. Right? And so that is still true these days. And by the way, look around and ask yourself, the most successful people what do they do with the money that they have left over? And you find that almost all of them put their money in real estate.
At some point, yeah. Whether they made it there to start with or they got it somewhere else, they end up in real estate.
Yeah, exactly.
Axel, last thing I've got for you. What would you say is the biggest challenge facing everyday people when it comes to finances?
I think the biggest challenge is that you need to put yourself in the mindset of you can get out of the day-to-day and you can actually create, literally with full control, create your own future by, on the one hand, becoming aware of what you have and what you spend it on. Mm-hmm. And on the other hand, develop a journey or a path to what I call the economic independence number. And yes, you can do all that research yourself. I always feel it's smarter, and I have used it myself and done it myself, is connect with people who have done it before, who can prove, like we do at Ideal Wealth Grower. You can go on my profile and see all the 10 properties we own. Every single one that we did, and I can explain every single deal. I make every relationship to any of our providers available. It's not that many, like I said, it's only 5. Yeah. But that's what you want to find. You either can learn all of this yourself, or you get somebody who helps you accelerate the learning curve by piggybacking from their experience and learn from them directly.
Yeah. No, I love that. Axel, this has been a ton of fun. I really appreciate you sitting down. I want to leave you with the last word. So a couple of things, whatever you want to leave the audience with message-wise, and then also let us know how we can connect with you and learn more about Ideal Wealth Grow and what you're doing on the real estate side.
Yeah, absolutely. So you can reach me at axel@idealwealthgrower.com. For your audience, we created a mindset manual that you find at idealwealthgrower.com/free, and it asks you for a little coupon code. So you put the word William, and then that basically gives you the download. And on our YouTube channel, which you also find under Ideal Wealth Grower, we have a little video series that accompanies the mindset manual book, so that you get a little more in-depth information of how to use it and actually get yourself in the mindset that ultimately makes you a successful real estate investor and allows you to reach this point of economic independence.
Awesome. Well, thanks again. Thank you so much, Axel. This was a ton of fun. I appreciate you sitting down.
All right, great. Thank you, William.
That's it for today's episode of the Silicon Alley Podcast. I hope you enjoyed the conversation with Axel Meierhoefer. On your way out, please share the podcast with others. It's the only way that the community grows and others hear these incredible stories from entrepreneurs and top performers. I take pride in telling a mix of stories from people that have never had the chance to tell their stories to notable names that you're familiar with. So please do your friends and family a favor and share Silicon Alley. I'm William Glass, CEO and co-founder of Ostrich, and of course, your host of the Silicon Alley Podcast. Have an awesome day.
You got no time to waste, but still you hesitate. Caught in a circle saying I'll never